All right, everybody, let's get started. Uh, Gentlemen, ladies and gentlemen, we really appreciate you joining us this afternoon and taking time out of your busy days to be with us. We look forward to this discussion. We hope it is very informative for you and a look back of what's been a really incredible 12 months. My name is Adam Paoli. I am the founder and lead wealth planner at Coltiva Wealth Planning Partners. And allow me to welcome you to the next episode in a series of webinars that we're hosting alongside pertinent subject matter experts that are within our network to help provide you useful information about what's important now. Many of you know the team at Coltiva Wealth, and you know we remain passionate about educating and helping people. Most of our waking hours are spent either face-to-face or now screen-to-screen with our clients, helping them to establish goals that impact their finances and their families, designing strategies to achieve those goals, and then helping them execute them. Along the way, we're very blessed to be able to build deep relationships with our clients and are passionate about helping them beyond just the management of the investments, discussing topics like where to retire, which is increasingly not Illinois, how to teach their next generation about wealth and money transfer, how to remove the anxiety behind critical life events and decisions, and many other conversations as part of our Path to Prosperity process. Last year, we had our guest speaker join us during the height of the COVID-19 pandemic, and we thought it best to bring her back 1 year later to review what's transpired and look forward to what a full recovery might look like. Our format today is going to be a little bit different than last year. We're going to have a Q&A format featuring some questions that are the most frequent ones we've heard from the minds of our clients. And before I introduce our speaker, a couple of housekeeping items. Number one, our webinar is scheduled for 30 minutes today. So we're going to try to stick to that so we can get you back to the rest of your evening. We do have prepared questions. If you do have any questions, feel free to put them into the Q&A session at the bottom of the Zoom link. And we'll try to get to those. And anything we don't get to on today's call, we will be sure to follow up with you directly. And it's important to note all participants are going to be muted during this conversation. So if you have any technical issues at all, I ask you to please email Mary in our office at mary@coltivawealth.com, or you can message me directly in the Zoom comments. So without further ado, let me introduce our featured guest today, Kezia Samuel. She, again, joined us last year, and she is the Director of Client Portfolio Management at Asset Marks Trust Company, which is one of our partner firms. She's responsible for writing their commentary on market performance and current events, and taps her over 20 years of experience to do so. And Kezia, I imagine you've had quite a boring year over the last 12 months without much to write about. How have you been able to manage to fill your time?
I don't know. I think life, I'm okay with it getting less exciting than it was a year ago, Adam. So I very much welcome the new change to whatever the new normal is. But perhaps a little less excitement is something all of us can deal with in the near term.
Amen to that. Well, let's jump right into the first question, and it's more kind of a general statement. Give us your take. What's your take on where we stand 12 months later after our last call?
You know, there's been a wide swath of events that have taken place, but I'm going to focus our comments today on how the markets have reacted 1 year after. Let me see, Adam, if I can proceed with these slides. I'm unable, oh, it's a bit of a delay, so bear with me. I want to take us to this particular slide here. And that hits on the very theme, the question you asked. Where are we a year later? How have the markets reacted? What I thought we would do is look at a few equity indices, so some of the stock benchmarks around the globe. How do they do post the fall and then the recovery? So what you see on the screen here are 4 key stock indices. We're looking at 1,000 of the biggest stocks in the United States. That's the far left-hand side. Right next to it is 2,000 of the smallest stocks in the United States. Right next to it is going to be stocks in Europe. And then finally, stocks in emerging markets, countries like India and China. The darker blue section on the bottom is how each of these stock indices fell during the crisis period. And you can see many of these stock indices, with the exception of small cap stocks, the second bar, all fell roughly 30% or so. But since then has made a remarkable comeback in equity markets. The US stock markets, and this is ending through March. And so you can see the US 1,000 of the biggest stocks have generated nearly 84% in returns, creating a total return, that's the number all the way on the top, of nearly 26%. Add the gains of April, and we're sitting just over 30% after having lost 30+% in just 23 days or so. So a big surgeons coming back from lows of March 2020 to strong gains. Similarly, if you look at our counterparts in Europe, and that's the international developed index that you see here, had a similar 33% drop and then a 68% comeback to generate 12%. You'll see that Europe is slightly behind, likely given that they were behind the curve in how they were able to handle the COVID recovery. And as such, the equity returns are not at the same pace. Emerging markets also had a 30% pullback during the crisis and has made an 80+% comeback from the bottom, generating nearly similar returns to the US equity markets through April. But the clear winner on this chart here has been small stocks. Small stocks initially struggled. It certainly was not able to keep pace with the technology names that gained all the attention, the Netflixes of the world, the Amazons of the world, as we were all tethered to our technology system. But the news of the effective vaccine shifted that tide entirely around, allowing smaller companies that need footprint of people walking into their shops, giving them the reopening ability to generate new business. As such, even though it took the biggest fall during the 1 year of down nearly 40%, it has made the strongest comeback, up 131% to end through March, 39% through end of April, nearly 44% or so. So with that, this is where we stand in the markets. Big drop, big comeback. And I think the underscore message that I have for this, Adam, on this question is, I think we all, if we had been asked the question in March of 2020, where do you think the bottom is? I'm certain that all of us would not have been able to say that it would have only lasted roughly 23 days. That's the sell-off. And from there on, it has started to turn around and has never looked back. A good reminder for investors to not try and time the market, because trying to do that is nearly impossible. And this chart explicitly tells us that.
No, it's a great point. And I think when we see this unbelievable run up from the bottom, we're now getting a lot of client concerns that we've recovered too much too quickly. And some clients that have said, well, was that really a recession given that the pace of not only the decline, but also the recovery? So tell us your thoughts on that. And if you believe investors should still be putting cash to work.
Indeed. One of the things that the adage of don't fight the Fed has been surfaced here, which is this is the Federal Reserve standing in supporting capital markets. One of the reasons we saw the markets come back and recover as quickly still stands. The Fed has made it very clear they want to be supportive. I would say add to that, don't fight the government at this point with the amount of stimulus that is being pumped in our capital markets, or the system, so to speak. And so from that perspective, as the economy reopens, we certainly are in a much more supportive stance here to allow the economy to heal and thus companies or corporations to generate positive earnings. But having said that, I think the question that you're asking for, the heart of what everyone wants to know is, am I going to be the one that invests and then the markets fall, 49% or 50%? What do I do then? Let me walk you through this chart and bear with me as I'm going to fast forward back and forth. Some of these slides are not in the order here, so bear with me as I get to this particular slide to show specifically how do we look at investing at what we call as the worst market timed day. You are the investor, you came in, and guess what? The next day the markets fall 50%. That is our fear. And that's a fair question given that we have gone on to set new highs every other month, every other day. So as an investor, how should we be thinking about this? That new lump sum of money that's being invested, what should the time frame be? Let's begin with the chart on the left-hand side that looks at the bar charts. This is assuming that you started, and again, as I mentioned, you picked the worst possible day, markets dropped 49% the day after, and then we look to see what would it look like historically having experienced such a drawdown or a drop 5 years later, 10 years later, 20 and 30 years later. Look at the 5-year time frame, Adam, and you'll see that yes, we went one more forward. Sorry about that. In the 5-year time frame, you'll notice that yes, if we had such a big drop, given historical patterns, that there's a chance we're slightly positive. We're up 5 or 6% here or so. So it doesn't, maybe we could be slightly negative, maybe we would be slightly positive. But look at the year on the 10-year returns on the 10-year basis. And that's where, even though it's only shown as a 90, that's 96%. That's a big jump, but when you compare it to 20 and 30 year, which is why the numbers on the left-hand side look so small, is because they're being compared to 615% over 20 years and 2,200% on the 30-year basis. So what does this mean? What this means is that as an investor, investing at all-time market highs means that this particular portion of the money likely needs a longer period of time should we sustain a sell-off. Now, that's not our base case, but I certainly don't know when the market tops nor bottoms. But give that particular portion of money a little longer. Most clients may go, well, I don't have time. Likely we're going to all live a very healthy, long lifetime, and some portion of that portfolio could have longer time frame, and as such needs to be considered in those lines. What do you see on the right-hand side? The left-hand side is averages using all of the worst time periods from the Great Recession to the Great Depression. Looking on the right-hand side, for each of those crises, we as investors have experienced some or all. If we're lucky enough to live a very long lifetime, it shows that, again, in that 5-year period, you'll see that there are possibly more negatives than positives. Again, picking the worst possible day, but look at the 10-year, look at the 20-year, and look at the 30-year. On the 10-year basis, there's only 2 instances where the markets were flat to slightly negative. 20-year, 100% of the times were positive, and 30-year, 100% of the time positive as well. So again, conclusion here is, if the market goes on to set new highs, likely give that particular portion of your money a little longer. Now, the reason that I mentioned that we need to continue investing is because, let me go one more slide forward, if that's possible. Okay. Well, the reason I mention this is, as investors, we're always looking for when the market crash is going to come. And so we wanted to go back and look at what percent of each calendar year does the stock market go on to set new highs. And this is using the S&P 500. I picked 2013, Adam, specifically for the reason that the great financial crisis had just happened. The markets had fully recovered. And then I started to get the question of, when's the crash coming? When's the crash coming? So we went back and said, what percent of each calendar year does the stock market go on to set new highs? Take a look at this number. Each year, starting from 2013, 18%, 2014, 20% of all trading days have gone on to set new highs, meaning that I don't know when the top is nor the bottom is. Rather, what we can control is how we enter the markets and how we control ourselves to stay invested throughout. In fact, the last nugget I'll mention, in the 100 years history, the S&P 500 on average has gone on to set 5% of all trading days as new record highs. So I certainly, again, don't know when the top or the bottom is, but I do know that markets, just because it's gone on to set a new high, doesn't mean that's the last time either. So hopefully a little bit of a nugget on how to look at, as we enter new highs, maybe think of this particular bucket of money for a little longer, but just because we've had a new high doesn't mean it's the last one either.
Yeah, that's valuable feedback. And we often talk to our clients in looking at assets in terms of segments between shorter term and longer term assets, and giving them the time that they need to be able to perform. And that is a good transition then to go to what we traditionally position as more shorter and middle term assets in looking at bonds. We're hearing a lot of concerns about the potential for rising interest rates and the impact that that's going to have on bond holdings. Do you still believe that bonds have a place in investment portfolios today?
In short, the answer is yes, but what kind of bonds? And I think that's where we need to get a bit more finessed. Gone are the days, I think, where you could just buy a bond ETF and call it a day. Well, it's going to get a little bit more complex and a little bit more nuanced, and likely causing you to work much more closer with Adam and team here. What do I mean by that? I'm going to give an analogy here. You need to think of bonds in today's world using a barbell. So hopefully in the COVID crisis, we've all been working out. Occasionally I pick up my weights, and you have 2 things on either side. On one side is going to be, how do we generate income in a 0 interest rate world? I still need to pay my bills and live my life. So how do I do that? And that's likely going to cause us to either lean into lower quality bonds and or some dividend equities. And that could be one side of the equation. But to balance the risk that these lower quality investments bring, you need to have those higher quality bonds, but of shorter maturity. So this is where we need to have the shock absorber in the portfolio. And as such, something needs to be able to basically grab the portfolio during periods of turbulence. And that the only thing that has done so consistently has been higher quality bonds. But where we don't want to get stuck is buying a long bond, let's say of 20 years, likely causing, if I'm stuck with a 20-year bond and interest rates keep going up, I'm stuck. I can't get out of that bond, and as such, my bond prices fall. So bring that bond maturity in, thus giving me the ability to manage risk. The best analogy I can think of is this. Why do we still want to own bonds? They're not going to generate a lot of positive returns, maybe even give us a few small losses as we've seen here in 2021. Look at your house. In your house, hopefully it's never burned down, knock on wood, yet you pay insurance on it. Month over month, you keep paying that insurance, not hoping that your house burns down, knowing that that is a necessity as part of your well-diversified portfolio. So bonds are going to play that critical role in ensuring how do we manage the overall volatility, and slightly it's going to cost us akin to that insurance we pay on our house. And to manage some of that cost, we're going to lean in on some lower quality bonds or dividend equities as a way to generate the returns rather, that bonds used to provide for us. So hopefully I've given some nuggets and colors here to elaborate on, yes, bonds are critical, but how we execute matters even more so today.
Yeah, we couldn't agree more. And we spent a lot of time in our firm talking about exactly what you said, that the days of just buy, the PIMCO bond fund and then just, fall asleep next to it, those are long gone. And we're going to spend a lot more time having to get a lot more intricate and more active with our bond structure and a lot more thoughtful for that. And it's very important, as you said, it's also important to place it as to what we're looking for that driver to be. Is that a rate of return driver? Is that an income driver? Or is it a volatility buffer driver? And having more of a thoughtful approach to that will help define that for our clients. So let's move on to the next chatter that we've heard a lot of lately, especially very much so earlier in the year. We've been talking a lot about inflation, and it's interesting that a little bit over 12 months ago, we were on the precipice of concerns of deflation. And now we have a lot of clients that are concerned that we're going to see runaway inflation, and that's going to wreak havoc on the markets, and very specifically the stock market. So can you give us your take on how you think inflation is going to impact our markets?
Sure. Let's begin with very much, so bear with me as I'm going to skip forward a few slides, as you may be wondering. So 1 second, please. Let me get to that. Let me start with, where is inflation? I realize that my thumb perhaps is a little faster, and so it moves. Okay, I'm not going to touch it. Where is inflation today? And is it, as we call it, is the inflation genie out of the bottle and it's too late to pull her back in? So let's start with the left-hand side. The left-hand side looks at where inflation as measured by the Fed currently stands. And this is a little dated, so I'll give you the latest number. The latest number as of March is the target is at 2.4%, which looks like, if you were to continue that line and from February take it up, it looks like it's gone straight up. A few things here. What is the Fed looking at? The Fed measures inflation by looking at a basket of goods and services using this index called the Personal Consumption Expenditures Index. Fancy way of saying it looks at a basket of goods and services and measures it. It is slightly different than how Social Security is indexed for inflation. So do note that if you look at that and say, hey, how come it doesn't match up? They're not one and the same. There are differences in how they measure components. I won't get into that. Happy to dive in, but likely will put us all to sleep. But nonetheless, let's look at, as of March, I mentioned inflation stood year over year at an increase of 2.4%. That's the number, which is not on the screen because it's 1 month delayed. Now, what is the Fed looking at? The Fed is looking to average 2% target, meaning that as inflation over a period of time, it needs to sustain itself at 2%. look at the chart, and there's a dotted line underneath the Fed's 2% target. That is over the last 3 years, because inflation's been running so low, the average inflation currently sits at something like 1.7% or so. So still below the Fed's target. What would it need to get to in order to hit the 2%? Something like a sustained 2.4% for a period of 1 to 3 years. The Fed hasn't been very clear on how they're measuring the average rate. So, first point, it is still below the Fed's rate of target in how they're looking at inflation. The difference here this time is that the Fed is not forecasting inflation, but rather waiting for inflation to come through. Why is that? Because over the last 10 years or so, we have seen, despite the amount of monies we have spent, that inflation has been non-existent. So they want inflation to be here and stay persistently before they make any directional changes. Why is that? I'll give you a little nugget here. Let's go to European Union 2011. We're in a little history lesson here. In 2011, we had a very similar scenario. The European Central Bank, the ECB, was looking at commodity prices, which was skyrocketing on a short-term period, which is exactly what we're experiencing now, due to some issues with China. The European Union and the central bank raised interest rates by 50 basis points, or 0.5%. As a result of that increase twice of 25 basis points, or 0.25% each, the European Union has struggled as a whole just because of those two rate increases. The Fed worries that they will be in a similar boat, in that they're going to start raising interest rates to curb inflation, but inflation is not really sustainable because it was transitory. That's the word you keep hearing the Fed using, that they think that the inflation we're seeing here is transitory. Why do they think that? Because of the chart on the right-hand side. The chart on the right-hand side looks at unemployment. And unemployment has certainly come from the peak of April 2020 at 14.8%, currently sits at 6.1%. When there is a big swath of people that are unemployed, the issue here, Adam, is that it's hard for wages to keep going up, knowing that there is a broad set of people still unemployed. Why do I talk about wages? Because the number one driver of inflation in any good and service is people, right? How much we get paid is what really drives the cost of goods and services. Now, we are seeing some temporary rises in the in wages, but is that because unemployment benefits are greater for a certain period of time? Yes, but is that going to go away? Also, yes. So right now, what we're getting is a few very small data points that tells us, yes, commodity prices have risen. Why? Because demand went from 0 to 100, but supply couldn't keep up. As the supply normalizes, can that trend continue? Now, that's $1 million question, but again, we don't have a definitive answer. So to draw a conclusion that the 1970s style inflation is here to stay is too premature. This requires us to watch the data point a little bit more closer and then draw a more definitive conclusion. So yes, inflation is rising, but rising from very low levels of April of 2020, where it fell off the cliff. Second, many of these are imbalances that we need to wait and see over the summer months how they balance out. And last but not least, it's too premature to think that inflation, like a 1970s style, is here and here to stay. We don't have the data points just yet to support that conclusion.
No, it's very well stated. And you mentioned something there that leads into our very next question, where we're getting tons of concerns about is taxes. You mentioned about debt payments and what that happens with rising interest rates. But it seems and appears that tax increases are inevitable. Do you agree with that? And if so, do you think we should be worrying about rising debt issues, and what higher taxes are going to mean for the markets?
So let me go one slide above, and we'll talk about the debt, and I'll talk about taxes separately. Let's look at our debt. And I do think that in the financial world, context always matters. And so what we've done here is compared on the far left-hand side of the bar, the impact on the economy that the great financial crisis had relative to COVID. And that's blue and orange respectively. You can see the great financial crisis, in fact, took a much bigger chunk out of our economy than COVID did. Why? Because of the amount of monies that were spent to hold back the bottom from dropping out. And that's precisely the next set of bars you see, which is during the great financial crisis, the Fed and the stimulus that was spent was roughly 4% of the size of our economy, versus at COVID, it's 20% of the size of our economy. So certainly this has taken the debt. The entire US economy is roughly 20 trillion. We've spent 5 trillion so far. That's the 20% number you see. And as such, it's taken our debt to GDP to 100% for the very first time since World War II. But when you look at that number, again, it only paints one half of the picture. So one side of the coin. The other side of the coin that's equally important, and one of the reasons that markets aren't freaking out, is because the chart on the right-hand side. The red line depicts the debt, and you can see, yes, that has risen, but look at the yellow line. That's the interest we pay on our debt. And despite our debt being much higher, the net interest cost we pay is much lower. Think of this like an adjustable rate mortgage. So if you're going to buy a house, a more expensive house, which seems to be the natural course today, if you get an adjustable rate mortgage, you can buy that bigger house because your monthly nut is lower. Same example to how the Fed is looking at our debt. So this is essentially allowing the Fed to kick the can down the road. It doesn't change the scenario, but it allows for a little bit more breathing room as the economy grows to pay for some of this debt. Inevitably, though, it will lead to higher taxes. I think that at this point, we can all agree that higher taxes are in the realm. What I don't have in this particular presentation, but I do have a separate article that I wrote about, is we looked at, and this is fascinating, we looked at the last 13 times the US economy experienced tax increases across corporate, personal, and capital gains. And in 12 out of the 13 times that these taxes went up in one way or the other, stock markets went up. If you're thinking that sounds wrong. Taxes, yes, they're a burden to stocks. However, they don't happen in isolation. Typically, when taxes are being raised, it's also being pumped with some type of stimulus. In the past, it was defense spending and or some type of social governance spending. I think today there is no shortage of some type of stimulus or the other. And so it's very hard to use taxes as a predictor of where stock market returns will be in a given calendar year. I'll give a very specific example. The last time capital gains went up was in 2013. It went up by 9 percentage points to 25%, and then was cut in 2017. The stock market in 2013 did a whopping 30%. Why? Because something else was taking place. So the story in short is that yes, taxes are important, but they're not a good predictor of what calendar year stock returns are going to do. So don't make big rash decisions based just on that headline story alone. So hopefully you get a bit of a sense of where the debt is. Yes, it's rising, but it's manageable given where interest costs are today. And second, simply don't draw a conclusion that higher taxes should mean doom for stocks. Historically, that's not necessarily been the case.
No, that's outstanding, and I think our clients would love to read that report, and so we will make that available. So if you would like to reach out to us, send us an email to be able to get you that report. If you are so interested and you love chopping up taxes, we would love to send that over to you and have you read that with us. We'd like to open up some questions. If anybody has any quick questions, we're running to the end of our prepared time, so we'll see if any of these flow in. Casey, I think you've done such a good and thorough job that we don't have very many questions yet at this point that you haven't already covered. So Casey, thank you so much. We appreciate your time and your expertise. And as we wind this down, ladies and gentlemen, I want to thank you again for taking the time. We're trying to make these a little bit shorter now because it seems like after 13, 14 months, everybody's pretty zoomed out. And although these are really unprecedented times, we hope that you guys can find comfort knowing that your team at Coltiva Wealth is here for you. And we're going to be available to discuss what's on your mind and the concerns you have, not only regarding the markets, but anything that affects your financial life. Our goal is going to continue to be to do whatever it takes to help you look to your future with anticipation, not anxiety. Please don't hesitate to reach out to us. And if we can be a sounding board to you or your family and those you care about, we are glad to do so. If they're important to you, they're important to us. Everybody stay well, make healthy decisions, and we hope to see you soon. Thanks so much. And thank you, Kezia.
Thanks for having me.